Well, first of all, we're very fortunate that the culture that we have at the firm invites this type of thinking. This doesn't work in every other firm. A lot of firms would say, why are you wasting your time doing this? But Bill was an early adopter of the Santa Fe Institute. Michael Moguson, as you know, is our chief investment strategist, came over from Credit Suisse. He's a great author, great thinker. He's on the board of trustees at Santa Fe. So, I mean, we think about it at many different levels, but at the market level, what we, I think, have done well is to recognize that it's not an equilibrium-based system, as modern portfolio theory dictates it should be, that it's more biological in nature. And when you begin to think about markets from a biological aspect, you recognize that nonlinear systems are going to have these flares, these 5 standard deviation events, which are not supposed to occur in physics-based systems, but actually occur in biological systems all the time, and actually occur in markets all the time. So you're not as ruffled or unsettled when the market flares and gives you these nonlinear events, because you go, well, that's exactly what markets are supposed to be. So one, you don't panic as if the world is coming to an end because you've gotten this something that's unusual. It's really not unusual at all. But the important, what Charlie pointed out is that to benefit from this, what you said, Oliver, kind of sparked something in my mind, is that you can't spend 90% of your time becoming an authority on physics and biology because you've got work to do on valuing businesses. But you can spend a little bit of your time understanding the big models and how they work and how they may relate. And that's what we did in investing the last little while. It was trying to give you a surface view of how these models work. So you've got a working knowledge of physics, you've got a working knowledge of biology, evolutionary biology. Psychology now, thankfully, is much mainstreamed in our business, and so we try to add a little bit more there on risk tolerance and things of that nature. Philosophy, though, I think is a huge part of our business that we don't spend any time incorporating into our thoughts. So, for example, Ludwig Wittgenstein, probably one of the greatest 20th century analytical philosophers, is very big on language and descriptions. And he goes about, pointing out that, the way in which you describe something is your ultimate explanation of it. But there are many different ways to describe things depending upon the language that you use to describe it. So, for example, on Amazon, there were so many multiple descriptions on Amazon at the time. Same company, you had all the statements, financial statements, you had the SEC and everything like that. And it was amazing how many different descriptions were going on about the company. Some said it was, Barnes and Noble. So, and they would kind of think, well, if it's Barnes & Noble, it should trade like this. And others said, well, no, now that they're doing music and clothes and other things, it's Walmart. And so they would look at Walmart and they would try to say, well, it should be valued like Walmart and stuff like that. And we thought differently. We thought the description of Amazon was not like Barnes & Noble or Walmart, but it was like Dell Computer. And so Dell Computer, as you remember, in its heyday, was a direct distributor of retail products. They took, over the phone or through the internet, they would take orders. They would put the personal computer together in a distribution system, in a distribution center, and mail it out. They'd get your credit card, so you get your cash first, pay the suppliers later. They were the very first to get to triple-digit return on invested capital. And Amazon basically had the same model, which is they didn't have a bunch of stores and 100,000 employees like Walmart. They had 7 distribution centers. They took orders over the internet. They shipped them out from the distribution centers. They had your cash. They could pay the suppliers later. And they too went to 225% return on incremental capital. So you could have made that bet on Amazon in 3 different ways based upon the descriptions that you're using, but it's the same company. So the words and the language and your descriptions ultimately form the explanation of what's going on. Well, we see this happening all the time. The same company, and how many, look at analyst reports. How many, you get different descriptions of the same company. You get different descriptions of the economy. You get different descriptions of stock markets. And it's important for you, I think, to understand that you need to work through these descriptions to try to figure out, is that the right description, or should we be thinking about it differently? So philosophy has been a big help to us. We had to go back to mathematics, not just the dividend discount model and pluses and minuses, but things about central tendency of value averages. We're talking about central tendency of averages. Stephen Jay Gould did a great job in his book, The Full House, is that when you think about averages, you don't think about variance. You think about the average, you think about that number, right, the central tenet, but you really don't think about the variance on either side. Well, you got to think about variance. I mean, the market is full of variance, and we have a tendency to calculate it and think about it in averages, but the variances are more important than the average. And so how do you think about that? Non-stationarity. And in markets, the data here that we have in markets is non-stationarity. they change, right? The population set changes. If the population set doesn't change and it's the same group of companies that you are measuring 5 years ago, 10 years ago, 15 years ago, and today, then you can draw simple averages from it and say, okay, this is the average of these companies. But if the population set begins to change, it's called non-stationarity, then coming up with things like reversion to the mean or averages makes no sense whatsoever. So Warren got it wrong in the 1980s because of non-stationarity. He said that he thought that the return on equity had plateaued permanently high at 15% return on equity, and so it needed to revert back. Well, that was wrong because the composite of the S&P 500 had slowly changed from being an industrial base, utility base, heavy capital-based system into services, consumer stocks, pharmaceuticals, technology, which had totally different capital structures. And so with a new population set, you ended up with a new average. So it didn't revert back to historical norms. It changed. The trend changed, right? So there was no reversion, there was a new trend. And we're seeing it today. The argument today really is quite silly about profit margins. People are convinced that profit margins must revert back to their long-term average, reversion to the mean. Well, the data set's not the same. We know that the multinational companies today have much more exposure to overseas markets, and we've done enough research that their returns of their overseas subsidiaries have higher margins, higher return on capital, higher sales per employee, productivity is higher. So you can look at the relationship of profit margins to exports of the S&P 100, and then basically they're just correlating perfectly nice. So why should we have a reversion to some historical mean going back that says it has to go back that way? That's wrong. Now, I do think there's something called reversion to trend, and the trend is moving up, and you might say the trend's got a little, the profit margin's got a little bit higher than trend, but that doesn't mean that you have to go back to mean. So there's so many things that you can make yourself a better investor and disarm those people that are not thinking about it correctly. And you don't have to spend, semesters and semesters on it. You just have to spend a few hours kind of trolling around in these different disciplines.